Welcome to our first of 4 alumni webinars in 2026, a guide to filing personal taxes in Canada. We're excited to have you join us. I'm Christy Katanko, your host for today's session. Joining me today is Fred Zhuang, a seasoned certified public accountant with a wealth of experience in financial reporting, management, accounting, and tax preparation. Fred has helped numerous individuals and businesses navigate the complexities of the Canadian tax laws. In his spare time, he also serves on nonprofit boards as the treasurer and offers his expertise to Canadians during the tax season. And today he is here to share his knowledge with you so you can confidently file your personal taxes and maximize your refund. Before I hand things over to Fred, I just want to remind everyone to please put their questions into the Q&A box, and we will be answering them throughout the session. And now I will let you take the lead, Fred.
Thank you, Christy. Thank you for the warm introduction. And thanks everyone for coming. I hope everyone is doing great. And I am sharing my screen here as a spreadsheet because there is some formulas, and let me know if you cannot see the screen. And otherwise, we're just gonna go ahead and get started. So in this session, we have roughly 45 minutes to an hour. We're gonna cover 4 topics. We're gonna try to file a basic tax return, and then we're gonna look at some additional topics that falls into the common and then complex. And then the last one, we'll see the tax filing requirements. So the way that these topics are structured is we can just take a look at all the paid softwares in the market. Like the major ones are the TurboTax and Cloud Tax. And this is exactly how they structure the tax software. They have different tiers, like the basically a per simple return. If there's a tier up, there will be additional line items that's more complicated. And this is exactly how this is structured. And the conclusion of this section, it will basically just hopefully that everyone will be comfortable doing a simple return. And if there's any additional issues, make sure to do our own research, keep the receipts, and then check the CRA website for updates. So we're gonna go ahead and start with a basic tax return where the person has only a T4. To achieve this, we need to learn 3 things. We want to know what the blank tax form looks like. We want to know how the T4 is linked to the tax form, and then we're gonna see an example. So the first thing, the blank tax form. So this one, we can see this from the CRA website. You can just Google T1, which stands for personal tax. And you can just see here it has 8 pages. So on this personal tax return for the 8 pages, the first 2 pages are just the general information, basically your name, address, date of birth, SIN number, and marital status. And then page 3 is all the earnings. So on page 1 and 2 are the basic info, and then page 3, this is your total income, all the earnings. On page 4 is all the deductions. So what that does is some of the expense that we pay throughout the year could be allowed under CRA rules to reduce our taxable income. And then the next page, on page 5, is the federal tax. So the next page, so it just means our income minus deductions times the tax rate. That is the federal tax on the earnings. And then on the next page are credits. credits are similar to uh, tax deductions with one small difference. The tax deductions we are allowed to carry forward. So that means if we have a expense that we didn't use in the current year, we can use them indefinitely in future years. The credits on page 5, these are non-refundable. So either you use it or you lose it. The deductions is going to be based on the person's marginal tax rate. So if this person uh, over here makes a lot of money, they will have a higher tax. So the tax deductions, it will reduce their taxable income from the highest bracket that they're in. The credits has a fixed percentage, which is the same as the first income threshold. So this number used to be 15%, and the new liberal government they reduced it, and that's the new tax rate. So the whatever number that we have in the deductions uh, reduce the taxable income directly at a higher tax rate, and whatever we have in the credits is going to be having the same deduction impact, but at a lower rate. So after the first 1 to 6 pages, that gets us to the federal tax payable. So tax minus credits at the lowest rate, that's the federal tax payable. And then we have the provincial tax. Usually this part is just always automated by the accounting software. And there's really not much to do to calculate. It just carry forward whatever the provincial tax rate. And we combine the two amounts that give us the total tax payable. On page 8, which is the last page, the tax paid, this is the number that we see on T4. So if you have a T4, I'm making an assumption here, it's a random person making 60,000 a year. And this person has a box 22, 84, 54. This is the number that you see on your T4 or on your pay stub. So on your pay stub, there will be a CPP deduction, a EI deduction, and a tax deduction. The cumulative number on the pay stubs, that is the tax paid. And that number gets transferred into this box over here on page 8. And then the final amount, whatever the net refund or balance owing, that is just the total tax payable flow through from the top to the bottom. So federal tax, provincial tax, total tax minus the T4 tax paid. That is the net amount. And this is the amount either we get a refund or a balance owing that we see in our CRA account. So that's the basic idea for the tax structure. The next point is now we have this T4. How does this get linked to the tax form? So on this T4, there's a few boxes. The most common one that we see is the income tax paid, CP and EI. The box 14, this is our annual earnings before tax. So whatever we make on either hourly rate or a salary, that's just the number that goes on here. And then the CPP and EI are using the CRA prescribed amounts. The EI is around 1.6%, and then CPP is about 5.95. If we want to know more, you can just go ahead and check the CRA website for the exact numbers, but otherwise, usually it's just automatic. So once we have the T4, each one of these boxes goes correspondingly to one of the tax form boxes. The first one, the box 14, on the T4, it goes to line 10100 on the tax form. So if we're looking at the tax form, line 10100, this is your total income. So it even says here, box 14 of your employment income. So this is the number that goes up here on the earnings. And then box 16, 18, and 22 just go exactly to the same logic. It goes through the one of the box on the tax form. So the CPP/EI are non-refundable credits. You can just see here, this is on the page 6, has the CPEI here and then the CPP. So this is where the box are. And then the one we just mentioned on the tax paid, box 22 on the uh, income tax that goes on line 43700, which is on the last page. Goes on here. This is the amount paid. So going back to the logic that we just mentioned, you will have this person with only a T4, but so it will have a earnings on page 3. It will have some credits, page 5 and 6. It will have the amount paid on page 8, and whatever is the ending amount, that's the balance. So if you do this on paper, it will just be 60K income and then minus federal tax credit, and then we get at the bottom of the last page. Uh, in this case, it's almost the perfect match. So we only have like a $3 uh, net refund. So whatever the number, it will be at the bottom of page 8. So this is how the T4 is linked to the tax form. And now we want to try this on the tax software. You go to the Google and just Google free certified tax software. Because we're in January still, the 2025 tax software is not ready yet. So we can only take a look at the 2024, which is the prior year one. On the certified tax software, there's different ones. There's free ones, and then there's the paid ones. Some of them are filing online. So the only one that we can use that's eligible on a laptop or a computer and it's free is this one here, the genuine tax. So this is the one that we're looking at. You're just gonna go ahead and download the software and then you install the software. Once you install the software, you will end up with a screen like this. It will ask a bunch of questions. So just pick the topics that interest us. In this example here, the only uh, point of emphasis that we're looking at is a T4. So we don't have anything else other than employment income. So that's the only thing that we check. And we're gonna skip everything else. Once we are satisfied with that, we just keep entering the basic information here. Normally the software will allow us to autofill, which the your income is already uploaded to the CRA account. So the tax software has a connection to your CRA account. They can just automatically pull the data. So you don't even have to enter. But if we were to enter this manually, we're just gonna go ahead and go to the section here and just enter the exact same data. So this screen here that you see is the exact same data that I have on here on the spreadsheets. So I'm just entering the same data on the software. Once we're satisfied with this, we're gonna close this and then just keep pressing next all the way to the end. try to get to the. So I'm gonna just go ahead and skip all the questions. Okay, so now we skipped all the way to the end and you view the tax return. So here I just all these data are completely made up. When we do our actual tax return, you're supposed to put your own actual info, but other than that, it will generate this tax return here. And you can see here on page one, this is a 60K assumed income that we made. And then on page 6 and 7, where we have the CPA and EI credit, this is automatically generated by the software. If we work, we'll have a Canada employment income, and we have nothing else. And then on the last page, this has the 8454, which is the tax that we paid on the T4. And at the end of it, this is how we get to the net. We have a $2 balance owing, and then once we are satisfied with this number, you just set to CRA, just click the file the return. You can just net file the return, and then we're finished. So that's the main point for this part. Just remember 8 pages of tax return, 1 page of income, 1 page deductions, 1 page credits, and then tax payable. The link between the T4 and the tax form. So we have a T4 with the major boxes. Each one gets transferred into a tax form box, and then whatever the number that we do here on the spreadsheet, you can do the same on the tax software. Once we view the return and we're satisfied, and we verify the number, we think this is all correct, you just send net file the return, and then we're finished. You can just save a copy of the return for our own records. So that's the main point for a basic return. And most people, especially the people just entering or people that doesn't have a very complicated earning structure, they will just be doing this, and it will be extremely easy. Okay, so this is the first part, and then if there's no question, I'm gonna move on to the next one. The next topic here are the common tax topic. This is just whatever that you see on usually the full service preparation tax software company. You can just see this, they're charging money for a tax return. This is what they cover in addition to the T4. So here we're going to cover 5 topics: employment expense, RRSP, medical, tuition, and donations. The first one, the employment expense. This is on line 22900. So you're going to go on the tax return. Remember the 8 pages, you can just find it. So here, 22900. Most of us who have a lot of employment expense, we're supposed to read the actual guide, which is quite long. It could be like a 50 to 200 pages. But the main point are 2 things. One is for us to be eligible for the employment expense, we need to file a employment declaration form. So T2200, we're gonna file this form here. and then just follow the form. Usually the people that care about this usually are the commission earning people or people that travels while they're doing the work, like the sales people, maybe like insurance agents, realtors, medical staff, any of those, anybody that's has to pay for the work and qualify. So then you can just go ahead and either put a yes or no on the form and give the employer to sign it. If the employer signs it, the next step it will be to calculate the total expense. So you just use the form T777 and we'll do the exact same. We can just see here whatever the expense that we have, you can just put it out here and you can just deduct them. So again, how do you do this on the tax software? You go back to the beginning from the type of interview. So if we have only the employment income, that's all we're going to put here. But if we have something else, let's say we have a employment expense, we're going to just check this box here. And then it will bring up the form. So employment income, employment expense, go ahead and go to the employment expense, and then you're just gonna enter the data here, and it will be the same as filling in the same form, but on the software. So everything will be the same, and we don't even have to calculate the subtotals. The software will automatically do that. So that's this part here, the employment expense. The next one is the RRSP. This is on line 20800. So this is from page 2 under the deductions. There's a few points that we want to know. So this RRSP stands for Registered Retirement Savings Plan. So the CRA give us a incentive if we buy some kind of qualified investments, it will reduce our earnings. So what does that mean? So let's say we buy like the same person that makes 60K, they pay like $5,000 to buy like a GIC or a bond, and it qualify for RSP. So then their taxable income is no longer 60K. Their taxable income is 55,000. So they get like a upfront deduction on their taxable income. So that's what that means. Usually we buy that with the bank or any of the brokers. And then we're going to answer a few more questions here. What is the amount limit? There is going to be a limit up to 18% of the active income. So this person here making 60K employment can contribute only up to 18% of that amount for that year. They can carry forward the RSP indefinitely. So if they didn't contribute the year before, they will be able to do that. Otherwise, if it's their first year, they will be able to contribute up to 18%, or there will be a max, which is 32,000. These numbers is published on the CRA website and they will change. Is there a time limit? For the year, if we're filing our tax return for 2025, we can contribute RSP between March 1st of 2025 to February 28th of 2026. The reason why this is not January 1st to December 31st is usually that some people could get a bonus right before the T4. Some people may have some planning and they may not be able to buy the products before year end. So the CRA design is not exactly January 1st to December 31st, but March to February 28th. Why not just max out RSP all the time? Remember from the tax rate is tiered progressive tax in Canada. So some people would buy RSP to reduce their taxable income, maybe from the highest tax bracket to the lower tier. They don't really necessarily want to contribute more to the next tier. So they just want to reduce their tax one tier lower. Not everybody has the cash on hand. Remember, when we make this RSP purchase, we do have to pay for it, even though we're getting the tax refund, but you still have to pay the amount for it. What happens if we withdraw the RRSP? Whatever the amount that is withdrawn is fully taxable in that year, except for buying homes and up to a limit. Again, this is just an overview. If you want to read more on the RSP, go ahead and just Google the RSP withdrawals and see what the CRA says on the tax rules. So this is the same logic on the tax software. And if we have more than the employment income and you have RSP, you're going to do the exact same thing here and just check this RSP withdrawals and it will show up. And then other than that, just follow the form. The next topic is the medical expense. This is also a very common one. So the medical expense, again, there's a guide for us if we want to read the full detail. You can go ahead and just take a look. The guide is line 33099. But to summarize, we have 4 rules. Rule number 1, the medical expense is either ours, our spouse, or a common law partner, and it must be eligible. So whatever is eligible, go on the CRA website and take a look. It's here. Has a list of expenses that's eligible. Rule number 2, paid within 12 months ending in the current tax year. So what this means is we technically could have expense paid between 2024, as long as the 12 months ends in 2025, you can still qualify for that. Rule number 3, only claim the amount that's not already paid by the insurer. So if we have an example here, the total dental bill 5,000, but the insurance reimbursed for 2,000, you can only claim the remaining 3,000, not the whole 5,000. Rule number 4, the formula is going to be the amount over 3% of net income and the prescribed threshold. So this is go on to the credits. This is on page 7. You can just see here the rule. 2834 or 3% of line 23600. This is the net income. So 3% of net income and this number, whichever is less, that's the amount that's allowed. So if we have a low net income, we are more likely to be able to claim more of the medical expense. If we make a lot of income, we need to spend the medical expense more than 2,800. If we spend 3,000 on medical expense, we can only claim like 166 if we make a lot of income. So that's what this rule means. Basically, incentivize the low earners to get more deductions. So here we do have an example here. If this person has a 4,100 total expense and then 3% of the earnings, 1,800, whatever exceed this amount, that's the amount that can be claimed. And then at 15 or 14.5%, that's the amount that we get back from CRA. The next topic on this is the tuitions. So the tuition, again, there's a guide. If we're interested, go ahead and take a look at the guide. Line 32300, just Google this one to find the guide. There's 3 rules on this one. the tuition you can carry forward indefinitely. Um, we get like a separate bonus on the Canada training credit. So the difference between the Canada training credit and the tuition is they overlap, but the rate is different. The tuition fees on the under the credit here, you can just see the tuition. So this whatever number that we see here, the tax impact for this one is 14.5%. So what does that mean? That means if we have $10,000 in tuitions, the impact for us is $1,450, not the tax rate is capped by the rate. And the difference between the Canada training credit and the tuition is this one gave us 100% deduction uh, instead of the 14.5%. The last rule is you can transfer up to $5,000 per year to the spouse uh, uh, or parents or grandparents so that if we're not using it, they can use it. So again, if we need to know how to enter the data or transfer, just follow the tax form. It will just say it will have everything on here. Like if there's some kind of transfer, it will just be on here. Like so, just go ahead and follow the form. The last one here is the donations. Again, it'll be a guide online 34900. You're just gonna look at the same CRA website. Look at the donations. It has three rules here. It need to be made to a registered charity, uh, and it need to be qualified. So on the CRA website, it has a list of charities that are qualified. So that means if the organization that will make the donation is not on here, you cannot make the donation, or if you make the donation, it wouldn't qualify. Rule number two, 75% of net income. So what does that mean? It just the CRA rule just prohibits people trying to make a huge donation to pay no tax. So whatever that they donate, and it cannot exceed 75%. And then rule number three, carry forward 5 years. So if there's any um, unused amounts, it can be carried forward. And the same with the donation and the tuitions on the tax software. You just make the choice. If we have it, you put a checkbox like the like here. If we have donations, medical expense, moving any of if we have any of this, you just pick on here. Like here has a charitable donation. If we gonna use this, just put a tick box here, and it will automatically go to the page that will ask the question. You just fill the form for that. So that's the 5 topics for the comment. And then next one, we're gonna take a look at the complex topic. We have 6 topics here: rental income, investment, self-employed, moving, childcare, and some provincial credits. Rental income. Again, go on the CRA website, take a look at the full guide. It's a lot of reading, but to make it simple here, it's going to be filled in on a form, and the form is T776. So you go on this form, again, if we're on the tax software and we have rental income, what do? You just check this box here, and it will automatically bring up this form in the tax software, and we just enter the data. This one has 6 pages. So again, first page is general info, and then next page, the expense. If we have it, enter it here. If you don't, leave it blank. There's a CCA here. So the CCA is the tax allowed version of depreciation. So what does that mean? This is the CCA rate publication on the CRA website, and it's categorized by classes. For example, let's say we are running a small business and we bought a vehicle. The vehicle meets either class 10 or 10.1, depending on the description, and it has a 30% on it. So what does that mean? So it means if we paid 30,000 for the car for 2025, you can deduct 9,000 because it's 30%. And usually there may be a half year rule on the first year, so it would be half of that. So it would be 4,500. If not, the expense would be 9,000. And you just follow the same form on the T776 for the rental. And we'll just do the same from the tax software. The next one on the investment income, again, just go ahead and take a look at the guide here. So it's these four lines here, 12,000 up to 12,700. So it's in the front in the earnings. So remember on page 3, the total income. The first one is the employment income. From the top to the bottom, the structure is the more towards the bottom is more like flexible, like self-employed. The top is more like employment. So if you have, in this case, a investment income somewhere in the middle here, so interest, investment, and capital gains, it will be here. So again, we'll do the same on the tax software. If we have investment income, you just select this one, and then just follow the rules. The dividend and interest is just one item, just whatever the number we get from the slip, that's the number that goes on the form. The capital gains, for example, if we bought Apple shares, we bought it for 200 and we sold it for 260 minus whatever the fees we have, that's the adjusted cost base. And then 50% of that is taxable. So on the schedule 3, you just follow from the top to the bottom, and whatever you can see here, acquisition, cost base, and then whatever at the bottom, it will have a 50%. So that's the number that's taxable. And this is the number. So that's basically it for the investment income. Just follow the guide and the schedule 3, and then it will go on one of the 3 lines. Same for the self-employed. It's the exact same as the rental income. So the only difference is the self-employed has slightly more deductions, and I use a different form. So this is T2125. And again, fill in your basic info, and then report cost of goods sold, total earnings, cost of goods sold, any general expense, and then whatever at the bottom, that goes on to line 13500 on the front. So it goes in here. The number here is whatever the net amount that goes in here added to the person's taxable income. Next one, the moving expense. This is a schedule for T1M. So the moving expense, who is usually claiming this? If this person moved to work or study full-time and it's more than 40 kilometers, you can make the claim for moving expense. Just follow the line 21900 T1M. Follow the same structure. So it will just say put the information and then how much kilometers moved, and then the details, and then on the next page, you just claim whatever the amount. There is a simplified method. So what that means is instead of putting the actual numbers on the allowable expense, it will just use a prescribed rate. And the prescribed rate, it will just be on the CRA website. Just go ahead and take a look at the rates here. Like it give you like a cent per kilometer. Just use that. After that, it will just be the same on the tax software. If you have moving expense, just put it on here. Like just check this box here, and then you can just do that. The childcare, everything is the same. Just check the box here on the childcare expense, and then just follow the forms. Usually, it's the person that's making the lower income is making the claim, and the reason for this is it gives them less deductions. The person making a higher income, it will be able to claim more on their taxes, but the CRA doesn't want that. They want to give you a lower claim. So that's why the person making the lower income usually claims. The last one on this topic is the provincial credits. So the two main one is the BC rent credit and the Ontario trade and benefit. If we're in BC, I think we can claim up to $400. And so if we paid rent, so again, just follow the tax form and just find the amount. The same for the Ontario trade and benefit. In Ontario, instead of getting a rent relief, we get like heat and electricity rent relief plus some property tax or rent if we paid it. So we just fill in the same form, and then that give us the deductions. So that's the main topics for the complex topics. And the final point here is some tax filing requirements. So we have a due date, a residency status, and a employee versus contractor topic. The due dates, you can just find them on the CRA website. The individual, April 30th, self-employed, people that makes uh, other type of income, they get more time. Deceased later of 6 months or normal date, 6 years of record keeping, there will be penalties, and it is quite a lot. And then if there's any updates, you go ahead and check the CRA website and just see what rules are changed. So what happened was the liberals, they had a increase in capital gains for 66% for amount over a new threshold, and the new government just waived it. So make sure if there's anything that's important, it will be listed on here. Next topic is the residency status. So the point on this one is if we're a Canadian and we make earnings outside of Canada, if we're a resident, we are taxed on worldwide income. If we're not a resident, so maybe we don't have any of the significant or secondary ties here. So we don't live in Canada, or maybe we're only here for like a few months. You're only taxed on Canadian income. So that's the main point for resident status. And then the last one here is the employee and contractor. So why does this matter? The contractor get more tax deductions. So for the people working in medical field, realtors, salespeople, they have accountants, they have an incentive to try to classify themselves as a contractor to take advantage of more deductions. But not everybody qualifies. So there will be rules here. The rule is the economic reality test, integration test, and specific result. I think we can take a look at this example here. This person works a fixed schedule using the company equipment, have to comply with all the rules. They're an employee. This person over here has a lot more freedom, could be classified as a contractor. And if we are not sure, you can send CRA for a ruling and call CRA or file for a CPT-1 request for ruling and let them classify the person if they're a contractor or employee. So the main point for this part is the income is either on line on the front is either line 10100 or 10400. Other than that, that's the main things. We do have 15 minutes for questions if there's anybody that has any questions.
Fred, I actually have some questions.
Yeah.
Just a reminder for everybody to put your questions in the question box below, as well as this will be on Ashton College YouTube to be able to refer back to when you are doing your taxes. My question is, if you have someone in you, like a dependent, and they are going to school in the United States, and they are working in the United States as a Canadian, do they file United States and Canadian taxes?
Yeah, Chrissy, that's a great question. So let's take a look at the rule here.
Okay.
The first thing is to determine if this person is a Canadian resident or a non-resident.
Resident.
Well, so let's say this person is in the US for 2025. So for that year, it is unlikely for that person to be classified as a Canadian resident because they're not physically here. So if
Okay.
that's the case, they will only pay tax for Canadian earnings.
Okay,
But let's
interesting.
say, yeah, so let's say this person is a going through the school in the US, but they're going to online school and they're in Canada. So in that case, they are a Canadian resident. So then they will follow the first part of the rule. So it will either be taxed on the worldwide income, and they will get the deductions uh, for everything. The
Okay.
next part of yeah, go ahead.
Oh, it was just very interesting. I know you went through this, but I obviously didn't catch it. So thank you for going back through it again.
Yeah. So the next part of your point is, what about double taxation? So if this person is a Canadian resident, so like they make money, they're located in Canada, but they're going through school in US and they're making some money in the US. And you're correct, they do have to file a W-2, which is a US tax return. So if they did pay the US tax and then, but they're also a Canadian resident, they're gonna pay Canadian tax again. So wouldn't that mean they're gonna be double taxed? You go back to the tax form here on page 7. There's this foreign federal foreign tax credit over here. So what is this? Whatever the amount that we paid on the US income, which is W-2, is gonna give you the same deduction on here as if we already paid the same tax in Canada, even though we didn't get a T4 in Canada, but we got a US tax, it will be the same. So you're only gonna get taxed once. So even though so what does that means? Basically, it just the person that's making the US earnings. It will report the earnings, not on this line. It will be on this line here, line 10400, whatever the money that they make. And then the tax that they paid is not going to be on the 4374. If they pay Canadian tax, it will be on this line here. But if it's not, it will be on the foreign tax credit. So the end result is they are not going to be double taxed. And this is the box for that reason.
Okay, thank you. And thank you so much for all the links because it's definitely something that I can look back in again as well. We do have a question in the box. We've got, how does Simple Wealth software compare to GNU Tax Standard?
Okay, so that's also a great question here. So let's take a look at here. So this is all the certified software. This is the Wealth Simple Tax. Um, the short answer is they're going to be 99% the same. The only thing is I can't put this on a desktop. This is like a web browser. I have to sign up for it. And I can't sign up with my real data for this. So you can see here, I used a random person with a made up data. But when we go into the Wealth Simple and you just pick the basic tax return software, it will pretty much be the same. Just answer questions. It will automatically fill the tax form based on the answer that you provide, and it will generate a tax form the same as this software and any other software for that matter is going to be the same. The question to ask is what is the difference between Wealth Simple and the other softwares? This one is a self-service option, so you have to file your own tax. These other ones are full service. So somebody else, you just give them the data and somebody else will do the tax return for you. And of course, they're going to charge you more money for that. You can see here, this is $40, $80 basic. This one is like 100, 250 because there's a real person behind this doing your tax return. But the Wealth Simple one, you're paying for the access to do your own tax return. And it's the same as this one, but it's on a web browser. And maybe the layout will be a little different. It's like comparing in accounting, say QuickBooks. They don't have the same interface, but it's the same result. They just do the bookkeeping. So the same for that.
Okay, thank you. And another question was, do you need to file taxes with your spouse?
Yeah. So usually, the two people who they're if they're classified as common law, um, usually they just file together. So you can just take a look here. If you put single, you just file your own return. But if you put married, common law, or any of these, at the bottom of page one, you can see here there's this box here, your spousal common law info. So what is the point of that? Remember, under the medical expense, it's shared between the whole family. So it's the uh, you or your spouse or common law partner. So the point of doing this, if you put a spouse here, you can claim their medical expense and the CRA will automatically approve that. Now, of course, the software is already designed like that. So we automatically do that. If you put a single, then you can't put their expense on this. But regardless, if we're filing, let's say we're filing the couple as the together compared to filing two single ones, it's still two tax returns. Each person get their own tax return. So it's just that if you put a spouse here, there will be a joint deduction that you can use. This other one here, the basic personal amount can also be transferred to the spouse. So there's some credits that's beneficial to be utilized for both. Otherwise, it is still two returns. Okay.
Okay, so there are definitely some benefits there as well. Um, And you had said the different dates. Is there a date that you would normally get all your different forms in by, like say from your employer, your T4 or your taxation, um, charity, that sort of thing? Would you get those sent to you in the mail or via email by a certain date?
Yeah, that's a great question. So for you can notice here this one here, the individual is due April 30th. So we should add another line here, the T4 due date from the employer is February 28th. So you're gonna get everything on February 28th or before. And what does that mean? They give you 2 months to file a personal tax return. Most people will issue the T4 long before this. I have already issued, or I have not issued that the T4 prepared, but I will probably issue them in the middle of February. So they will have the proper time to do their own taxes. For this other person with a self-employed income, it's due June 15th. Why is this one getting a additional 1.5 months? That's because the corporations file their tax 6 months after the year end. So if this person is self-employed under the tax rule, they're using a T2125, which is a business income form. This is almost the same as a corporate tax return, but just a simplified one. So that's why these people follow the similar rules as how the corporate tax are filed. So the corporate tax gets 6 months after year end. The individual usually year end December 31st. That's why they get 6 months the same time instead of the April 30th. For all the other RSP investment forms, usually we get them in February. Remember, the RSP contribution ending date is February 28th. So we can still make contributions or buy the RSP 1 month from now. And if you buy the RSP on February 28th, you might get it in early March. So that would delay the slip just by a little bit. But even before that, we already know how much we're contributing. So you can technically file the return even before you get the slip. Remember on the tax form, let's say we're interested in the RSP contributions. So I'm just gonna, you just select this RSP. You have a limit, and then you're just gonna put no unused, no whole buyer payment. But anyway, you just filled in the forms, and and I'll give you the answer. The RSP is Schedule 7. So you can just follow the form, just whatever we have. If there's any carry forward, and then there's any kind of current contribution, you can even see the date here. So this one is delayed to March 2nd, not February 28th. The date is kind of changing every year, but it's right around the end of February or early March. And whatever we contribute, it will just go on here. And then once we have all the numbers, we go back to the 20800. So you technically don't need the slip. Maybe we didn't get the slip, but you can still use the tax dollar to enter the amount. And then once you get the slip, you can just keep the slip. The CRA is not going to ask you to email them the slips. They only ask it if you if they will only ask if they require it. And also the RSP will probably be in your CRA account anyway, so they can just see it.
Okay. I have one last question. I know we're right at the end of time here, but I'm just wondering if this is your first time and you are filing your taxes and um, you make a mistake, but you didn't realize that you made a mistake. When it gets sent into the CRA, is someone looking through it and then they're going to contact you if there's some sort of mistake? Is there any penalty, that sort of thing?
Yeah, so let's say we filed the return for the first time. The first thing you're gonna have to sign up for a CRA account, and it will open up the access. And after we do that, once we file the return, let's say we make a mistake, the CRA is gonna take from April 30th when is the due date. Maybe they'll send you an email saying it's being audited or something, and then by usually by September, so 5 months, they'll send you a CRA letter saying they agree or they do not agree with a number, and they will ask you to send in supporting documents. That's when we email them whatever they ask for, like the PDF doc. Maybe they ask for the tuition slips. Maybe they ask for the RSS slips, any of that, and then they will look at it. If they agree, nothing happens. But if, like you said, if they do not agree and they think that something's wrong, they will just recalculate the tax. They will charge you the interest penalty, and then they give you a 2 weeks or a 1 month time to reply. If you dispute, you reply and you say that they made a mistake. You send them more evidence. They can reassess. If you don't dispute, you agree to pay, then you put the money in your bank account, and CRA usually will just automatically withdraw the amount.
All right, thank you. That's so much information, Fred, but thank you so much for everything. I think we don't have any more questions at this time in the box, and we have run out of webinar time. So I just want to say thank you to you and to our alumni community. Thank you for tuning into today's webinar. I hope that you have found some information that was helpful and definitely informative. So thank you again, Fred, for this presentation, and good night, everyone.
Thank you everyone for coming.